Hello everyone, this is Professor Kent. Today's recording is Appendix B for Chapter 8. We're going to cover this appendix through the two exercises that I have. One is a brief exercise and other one is an exercise. So we're going to do both of them and we're going to learn the material through the exercise. Again, this is Chapter 8, Appendix B. And in this first one is there's two type of costing: absorption and variable costing, and there's a difference between the both and how we calculate it. We first thing we wanted to do is we wanted to calculate the difference between the both methods. When you're doing we're producing an income statement either using a variable cost or absorption costing. That's what we're going to do, and we wanted to know which income will give you a higher income. But before we get to the higher income, we needed to calculate it. When you calculate it, the first what makes the both costing system different is their fixed manufacturing overhead. So the fixed manufacturing overhead, what makes the difference between the both? If this was their fixed manufacturing overhead, what we needed to do is we needed to know how many units did we produce in the month of March. So we produce, so the formula here is, if I were to do it, the fixed manufacturing overhead divided by the number of units produced. We, in this case, in this question, in March we produced 900 units, and the cost of fixed manufacturing was 360,000 per unit. Manufacturing cost will be $400 per unit. That's what will make a difference. So what we're going to do is, when you calculate both income, is that the difference between the both income will be the whatever your ending inventory is. So in this case, if you were to look at it, you produced 900 units. From that 900 units, and then what we did is we sold 750 units. If we sold them, what we have left or we have an ending inventory. The ending inventory we have is difference between the both is 150 unit, and the fixed manufacturing is 400 units. The difference between the both operating income, I will say, I'm going to put it here, absorption costing income cost. When you're using that and you're producing an income, and we have a variable costing, you're producing an income. So when we think of it, the absorption income will be higher if, because the production is more than what we sold. Production is more than what we sold. If what you produced, I'm just going to put it, what you produced and what you sold, if they both are same, then if they both are same, the income will, under the both method, under absorption and under variable costing, will be same. If you have a absorption and a variable, and then if you produce and you produce more than you sold, then your income will be higher. Income will be lower, of course, if they're using if they produce less, but they sold, if they produced less but they sold more, that means the income will be low. that income will be low. That means they're using some of their inventory that they purchased previously. So that's what, just to tell you how they're different. So but that sometimes doesn't tell you what we're doing. So what you have to do is you have to create an income statement using both methods, and that's what the next question it will take you is to produce an income and tell and then to reconcile that net income. That's what you're going to be doing. So you're going to be reconciling the income. You're going to be producing it, and then you're going to be reconciling it. So let's look at your first one. And the first one is they're saying Myra Simon has heard about absorption cost, variable costing, but unsure how to apply the concept from the data that is available. So I am going to do is our first costing method will be absorption costing method. Next one will be my variable. So we have 2 years, 23 and 21. So they said that now we are going to be producing the both years. So I am going to take this 2023 and we have 2024. If I have an income, first is going to be sale. So they sold in 23. What we did is we sold 15,000 units. The cost of each unit is 50, and that is my 750,000. And then the sale on the 24th we sold 25,000 units, and the selling price is 50. So my sale will be 25,000 multiplied by the 50. Just gonna maybe do this so that we could just maybe do a little bit more variable costing, and that is gives you 1,250,000. That's what it is. Now we have a cost of goods sold section. So we have a cost of goods sold. In that cost of goods sold, you have a beginning inventory, and we are going to add the goods that we manufacture. Cost of goods manufactured. And we are going to do less. We are going to deduct or less my ending inventory, ending finished goods inventory, ending finished goods inventory. This will be given to you in the question, and then when you do that, if you were to think about it, they didn't tell us. So in this case, what we did is our beginning inventory is in this case is a 0. The reason why is it 0, because this is the first 2 years of their operation. This is the first year and this is my second year. We started with 0, and we are going to add the cost of goods that we manufactured. How many units we produce, how many goods we produce, 20,000 units we produce. Now we have two type of a cost. We have a variable cost and we have a fixed cost. So when you're doing absorption costing, both the variable and fixed goes together. So we have a variable production cost and we have a fixed production cost. The variable cost is 20. So that's my 20. My fix will be, I needed to know what the fix is going to be. So we have the fix is 100,000. So fix is my 100,000, and what we did is we produced how many units? We produced 20,000 units. The fixed manufacturing cost is $5. Variable is 20. So this, if I add both, the variable manufacturing overhead cost for under absorption is 25. So that will be, if I add both, if I multiply it, that will be your 500,000. So I'm just going to put this here. Goods manufacturing, we have 20,000 and multiply by the 25, and that will give me 500,000. My ending. So what we have is we produce 20,000, but we sold 15. We're left with 5,000. 5,000 at 25, that's how much we're left with, and that is my 125,000. If it's an ending finished goods, we have to minus it. And what does, if I have beginning plus what you manufactured minus what you have in ending inventory, what did that give you? Cost of goods sold. And difference between the cost of goods sold and your sale will be your gross margin. In this case, if I add both numbers, that will be your cost of goods manufactured, and or we could call it cost of goods sold, 375,000, and difference between the both number will give me my gross margin. Gross margin only have one gross margin, and difference between the both will be my gross margin, and that will be my 375 minus your less your fixed marketing cost will be my 80,000, and my net income here, or net operating income, my net income will be my 295. The difference is when you're doing absorption costing is doesn't matter if it's variable or fixed, the manufacturing cost goes together. So that's what the difference between the both. And now ending of one becomes the beginning of next. So we have a beginning inventory, ending of 1 year becomes the beginning of the next year. If that's the case, let's put it together. My beginning inventory will be, I have 5,000, and the cost of producing that was 125. That'll give me 125, and we are gonna add cost of goods manufactured. So what we did is we produced how many units we produced. In this case, we produced 20,000 units like we did before, but the production cost was more. So we have two type of a cost. I'm going to put it in here. We have a variable cost and we have a fixed manufacturing cost. Variable is $20 per unit. My fixed is 120,000 divided by my 20,000 units that we produce gives you $6 per unit. My cost of manufacturing is 26 times my 20,000 units that we produce. That will give you 520,000. And now we have 20 plus the 5. We have nothing in my ending inventory. So my less ending inventory, whatever we produce, we sold. So in this case, my ending inventory is 0. So what we have is cost of goods sold. So my cost of goods sold is, if I have to add both numbers, that's my cost of goods sold. That will be my 645,000. Difference between the both, sales minus cost of goods sold, will give me my gross margin, and in this case it is my 605,000, my less my fixed marketing expense, and that is my 80,000, and that will give me a net operating income or a net income. So that will be my net income for 2024, and that will be your 525. So how we're going to do it now, we're going to show you variable costs, and then we're going to reconcile it. So let's do my next one is my next one will be doing the same income statement but using the variable costing. So we are going to be using a variable costing. I think I'm going to use it. So this will be for my 2023, this will be for my 2024. So first one is my sale. My sale was 15,000 units and the sale price is 50. My sale did not change for the first year. And my next, what we have is we have variable, we have to separate my variable and fixed. So we have a variable cost of goods sold. So we have a variable cost of goods sold. We have a beginning inventory. Add your cost of goods manufactured. Cost of goods manufactured. And deduct your finished goods. That didn't change, but the cost will change. Deduct, sorry, I put it deduct twice, and that is a deduct my finished goods, ending finished goods inventory. Inventory, and then we are going to less my fixed cost. Doesn't matter if it's a manufacturing or not, we have to separate them. My beginning inventory was 0 because we just started the business. How many units did we produce? They told us we produce 20,000 units. And now here we have two type of a cost. What we have is first, what we have is this, we variable production cost was 20, and that's the only cost we have, the variable. So if I manufacture 20,000 unit, my cost will be 20, and my finished goods will be 5,000. And if it's a 5,000, and it's gonna, the variable cost is 20. So if we add both numbers together, this is my 400,000, and this is gonna give me 100,000. If I what does that give me? This will be my variable cost of goods sold. So this will be my total variable cost of goods sold. Total variable cost of goods sold. Cost of goods sold, and that will be my 500,000. Difference between those two numbers will be giving me a contribution margin. So contribution margin, that will be my 250,000. Contribution margin will I added it, so that's my mistake. If you look at it, this is a deduct. So my cost of goods sold will be 300,000, and this will be 450. So 450 will be my gross contribution margin. It's a deduct. My finished goods, I have to deduct it. So this is my deduct. Then we're looking at is less my fixed cost. Doesn't matter if it's a production cost or variable cost. We have to put it together, and they told us in the question, we have a production cost of 100, and your marketing cost is that. So we have a manufacturing cost, which is 100,000. We have your marketing cost, which is also fixed, and that is my 80,000. If we put it together, that is my 180,000. Difference between the both number will give me my net income. So my net income is going to be your 270,000. Now if you look at it, the cost under the absorption is 295, where under the variable is your 270. So now what makes a difference? So there is a difference. The difference is 25,000. That's what the difference was between the both is, 25,000. And what is the difference when we think of it? When you're using a variable, you have your ending inventory. I'm just going to put it at your ending inventory, multiply by your fixed manufacturing cost per unit. What we're doing is we have to balance it to the net income that we have under absorption. So my variable net income here in this case is 270,000, and my ending finished goods inventory was your 5,000, multiply by the multiply by my fixed manufacturing overhead, that is your 5, and this is your 25,000. If you have an ending inventory, you have to add it. If it's a beginning inventory, you will be subtracting it. So beginning inventory multiply by your fixed manufacturing manufacturing cost. So then this will give, if I add both numbers, it will give me the income that we have under absorption costing, ABS, absorption costing income, which is 295. And what we're doing is we needed to reconcile. When you reconcile it, that's what you're going to be getting. So let's look at the next 2024 income statement under the variable costing, and then we're going to be reconciling it. First one, we have a sale. Our sale was 25,000, 2,500. And sorry, one extra zero, multiply by the mile 50, and that will give me the 1250,123. And we have less. We are going to do a variable cost of goods sold. We have a beginning. Add your cost of goods manufactured, and less my ending inventory, ending finished goods inventory. So ending of, when we have it, ending of 1 year becomes the beginning of next year. So in this case, we are going to start with the variable. My variable ending, the ending was beginning, sorry, ending of that becomes the beginning. So we have 5,000 at 20, that will give me 10,000, 100,000. How many units we manufactured, and we manufactured, they told us we manufactured 20,000 units, and we are going to say 20,000 unit. The variable cost they told us in the question is still 20, so I am going to multiply by the 20, so that'll give me 400,000. So now we do not have any ending, and if I were to add both numbers together, what will that give me? Cost of goods sold, and that is my 500,000, and difference between those two is my contribution margin. The difference between those two will give me 750,000. We have a less, we have a fixed manufacturing cost and fixed marketing cost. So we have a marketing and we have a manufacturing. They told us in the question, I believe the numbers were changed, 120 and 80. So I have 120,000, we have 80,000, altogether is my 200. That gives me net income under the variable costing will be my 550. So we needed to balance it. So if my variable net income here, we just calculated it, that is my 550,000, and we have beginning, we add the ending and we minus the beginning. So that's what we do, we add the ending. We have how many units, multiply by the fixed manufacturing cost. In this case, our ending is 0. Anything you multiply by 0 will be 0. So anything you multiply that, it will be 0. In this case, if this number is your 0. So what the next we have is, we have a beginning inventory. Our beginning inventory was 5,000, and in this case, what was the fixed manufacturing? So we needed to calculate the fixed manufacturing before we could do anything in order for us to get it to work. So we had, what we had was the that will be my 5 multiply by 5, which is 25,000. If you're ending, you're going to be adding it. If it's a beginning, you will be subtracting it. And what will that give me? It gave me my absorption, PTION, absorption income. That will be your 525, and they should be the same number. So that's how we reconcile. So the difference was 25,000. For one you add it, for the other one you minus it. One makes an ending, the other one makes a beginning. So one you add, the other one you subtract, and that's what the difference is. This was appendix for chapter 8, appendix B for chapter 8. Thank you for watching, thank you for subscribing, thank you for being a member of my channel. Take care and bye for now.